Let's take a look at an example that's a little bit different because it's from the perspective of a company located in another country. So in this case, we have a Korean company. It's Korean Airlines. And being based in Korea, they operate in using the Korean won. And they just signed a contract with Boeing to purchase some planes. So specifically, they're going to purchase a couple 747s. It's going to cost them $40 million. So they're going to pay in dollars in two equal tranches, so two equal payments. First one's already been paid for, so for this, we can just ignore that. But the next $20 million is due in 3 months from today. And right now, they have 17 billion won in a bank to make good on those payments. But as you can tell, the problem is that, they have Korean won, and what they are going to need to pay in is in dollars. And so they don't know really how much that's going to take in terms of won because, the payment's in 3 months. So whatever the spot rate of the dollar ends up doing against the won dictates what they'll actually have to pay. Unless, of course, they hedge. And so that's what the rest of our problem is really about. It's giving us a couple different options with which we can do a hedge, and then asking us how much are they going to pay if they remain unhedged and the exchange rate turns out to be exactly what the spot rate is right now. If they used a forward market hedge or if they used a money market hedge. So let's take a look at part A first. How much in Korean won would Korean Airlines pay in 90 days if they just went without a hedge, but that the spot rate in 90 days ended up the same expected spot rate, the same spot rate as it is now of 804 to the dollar? Well, actually, it's 4 above the current spot rate. Current spot rate is 800 Korean won. It's just that the advisory service that they're using to get exchange rate forecasts is saying that it's 804 to the dollar in 90 days. A is going to be the simplest of all because they know they're going to have to pay 20 million USD. And if the spot rate in 90 days is that 804 Korean won to the dollar, then it's that just a straightforward translation of currency, and it's going to cost them in Korean won 16 billion, more or less. But the risk, of course, is we don't know what the Korean won is going to be in 90 days, and so we don't know how many Korean won it's actually going to cost us to make good on our payment to buy this plane. And that's kind of a problem because this company only has 17 billion Korean won in the bank. And so if the Korean won weakens by enough, then they may not have enough money in the bank to pay for the plane. So this gives us no certainty. If we want certainty, we're going to have to look at either B or C here. B is asking how much in Korean won would Korean Airlines have to pay in 90 days if they used a forward market hedge. Based on the information that we've got, a forward rate hedge is going to cost 808 Korean won to the dollar. And with a forward rate hedge, as far as calculations go, the payment we can kind of treat similarly to what we did in part A. It's the accounts payable multiplied instead of the spot rate, this time by the 90-day forward rate. So they're locking in effectively what the spot rate is going to be for them in 90 days by buying this forward contract. A forward contract to buy the USD in exchange for won. So $20 million is the amount of accounts payable that they're going to have to pay to buy this plane. And so that's going to be the size of the forward contract that they buy. And then we multiply it by that 90-day forward rate of 808 Korean won to the dollar. And then that gives us how much it's going to cost them in won to buy this plane if they use a forward hedge. And if we do the math, we get 16.16 billion won. And that's going to be our forward rate hedge example answer to part B. Part C is going to ask us, what if we used a money market hedge instead? And the money market hedge is going to be as complicated as the forward rate hedge is simple. These are going to be the pieces that you'll need to compare a money market hedge to a forward rate hedge, but I find it a little easier to comprehend if I break these down into 2 or 3 parts. We're still going to need to pay $20 million. And the way that we're going to do that is today, not 90 days from now, but today, we're going to take our money that's currently in the Korean bank and go and deposit it into a euro dollar account. Basically an account that pays dollar interests. It's denominated in dollars. It doesn't have to be based in the USA. That's why we call it euro dollars. But the reason that we're eliminating our exchange rate risk through this step is that when we take our money out of the Korean bank, we convert it into dollars today so that we can deposit it into this euro dollar bank account. So there's our exchange rate risk taken care of. It's just that we need to size the numbers right because this account pays interest. And if we had kept it here instead, we would have earned interest here instead. And since these interest rates are different, we'll need to see how the relative difference of these two interest rates will affect the cost of how much won it's actually going to cost us. To make that more clear, let's focus on the first step where we take our money and deposit it into the dollar-based bank. If we just deposited $20 million, we'd have more money than we really needed to pay off to buy this plane. That's because the bank account, the 90-day interest rate is 5.125%. So on an annualized basis, we're getting 5.125% on a bank account. We're parking it for 90 days before we have to go and pay Boeing for the plane. But in the meantime, we're earning that interest. And so that's why we don't actually need the full 20 million. We just need a deflated number of 19 million and about 700,000. And since we converted it at the spot rate today, where the spot rate right now is 812 Korean won to the dollar, then that amount that we're going to need in won terms is about 16 billion won. And so far, we are mostly through our formula. We've got this part here where we've put up dollars in a US dollar interest-bearing bank account. And in order to put up those dollars, we had to translate them at today's spot rate. So we have these two components. We figured out how many dollars to put up. The last component is really about comparison. It's about comparing part B, the hedge using a forward market hedge, versus part C, where we're using now a money market hedge. The forward hedge, we didn't actually have to put up any money until 90 days later. The money market hedge, we had to put up money right away. Now, it did earn interest, but if we didn't put that money right away in a US dollar-based interest account, we still could have kept it in a Korean won-based interest account. And so that's why we're adding this little bit at the end to kind of make it a fair comparison to the forward money market hedge, where we didn't really require any money at all until 90 days later. And the Korean won deposit rate is 3.875%. That's an annual rate. And so we take that 3.75%, multiply it by a quarter, since we're just going to keep it in there, or we're not actually keeping any money in there, but we're considering it as comparison for 90 days. And 1 plus that number is what we multiply all this at the very end. So that breaks it all down for you. And when we sum up all these together, what we get is essentially a payment of 16.189 billion won. So that's how much it would cost us with certainty in won to pay for these $20 million planes in 90 days. Compare that, though, to the forward market hedge that we initially calculated, where it would have cost us $16.16 billion. And we can see that as far as which hedge should we choose, we'd probably want to go with the forward market hedge because they both eliminate our exchange rate risk. But this one is a little bit cheaper for us as a Korean importer than the other. Now, the question is not written here, but I want to address it just because you'll see the parameters written here in this third paragraph, and that's the approach of using a call option as a way to hedge. And if we use a call option, we're going to use a call option on the dollar. We're going to buy on a call on the dollar because if the dollar gets stronger, that's more expensive for us as someone who's paying in Korean won. It's going to cost us more Korean won to pay this same $20 million. So we want some protection against a rising dollar. We're going to buy a call option on the dollar. And when you buy an option, whether it's a call or a put, you have to pay the premium. Whether this option turns out to be a good hedge or not, you still have to pay that premium. And so that's going to be the first thing that we're going to calculate. We're still going to buy a call option on the full value of the amount of payments that we're going to make. So the size of the option is going to be $20 million. And the premium rate is going to be determined by the market or the bank that we're negotiating with. In this problem, the premium is 3.6% because here we're looking at buying a call option. The other one is a put option, which is not going to be helpful for us. So 3.6% of the notional amount is the kind of the percentage that we have to pay as a premium. And in won terms, right now the spot rate is 812 Korean won to the dollar. And so if we wanted to know what this premium was in terms of won, we use the spot rate today to convert that premium amount. And just because this is an amount that we have to pay today, and we're going to use, we're going to make a comparison between using a call option versus a money market versus a forward rate hedge, we have to, again, put these in equivalent terms by using the Korean deposit rate, which was that 3.875% we just used for the money market. So this amount in Korean won terms is going to be about 590 million won. That's the option premium. And then to figure out how much this is actually going to cost us in terms of Korean won to implement an option market hedge, it's going to be that option premium plus that strike rate for this option, which is 800 Korean won to the dollar. That strike rate is effectively like what we get to convert at if this hedge kicks in because the US dollar has strengthened. So if this call option becomes worthwhile because the dollar is strengthened, then this is sort of like the worst case scenario that we're going to have to pay. Even if the won weakens to below 800, so even if the won weakens to 700, it's the other way. Even if the won weakens to 900, so $1 buying more won, so weaker won, then this is the kind of worst case scenario of how much we're going to have to pay. It's going to cost us 16 billion won plus the option premium, which was that 590 million won. And so the sum of those two together, this is what we're going to have to pay in won if we use an option market hedge. And if we compare this to what we have looked at for the costs of using the other two hedges, we see that it's more expensive. That is, with certainty, the forward market hedge is far and away the cheapest one to us, Korean Airlines, in terms of the amount of won that we're going to have to pay. But the thing about an option hedge is that this is like a worst case scenario. We're never going to have to pay more than this because the call option is going to kick in and pay off for any value of the won above the strike rate. So if the won weakens beyond this, call option kicks in, profit on that pays off any additional cost for us. When it comes time to go and pay this plane, we take our won, convert it at the spot rate. If the spot rate for the won is really weak, no problem. We bought this call option. We use the extra money from the payoff of this call option to cover any additional cost of a weaker won currency. But the real benefit of where the option approach shines is if the won strengthens. So if the won strengthens, that's good for us as importers who are required to pay dollars to buy this plane. It's going to cost us fewer dollars. If the won, let's say, goes from 800 to 500, then the cost of that $20 million is no longer 6 billion won. It's now 11 billion won. Much cheaper for us to pay, although we still have to pay this premium. We're still getting a great deal relative to the other options that we might have chosen when we want to hedge. So the option approach, it doesn't give you complete certainty. It gives you complete certainty about your maximum cost, but it preserves the potential for upside if the currency moves the other way. And that's why it's not uncommon to see the option market hedge as a more expensive approach relative to something like a forward market hedge or even a money market hedge, because you're kind of paying for that potential upside, but at the same time capping your maximum risk.